Good morning, everybody. Hope you're well. Thank you very much for joining us today. This is our fourth year presenting at Mortgage Vision, so hopefully that means we did a good enough job to be invited back, and thank you very much for, if you've seen me present before, for giving positive feedback. We talked to you last year about how the market was doing post-pandemic, and the general consensus was that, yeah, we'd been through the mill, but actually the reality was we'd be kind of back to normal by mid-2022. Safe to say that prediction was completely wrong. Also want to caveat at this point that I wrote this presentation prior to Friday's news, so I'm going to try and link everything into what's happened over the past 3 working days or whatever, and try and kind of relate that to the economy, so just bear with on that one. So for the next 15-20 minutes, we're going to have a look at the economic climate, so kind of the position that we were in up until Friday, and hopefully give you an idea as to what's kind of changed since Friday, since the government mini-budget announcement. Also want to look at how that impacts us in the mortgage market. There's probably one big topic of conversation at the moment that we'll look at, and that's swap rates. So we'll try and do that in more detail, but if we've got time, have a look at some of the other topics that are kind of key in the industry at the moment. And then finally, a topic that we cover every year really, just about working together for the good of the customer, and more than ever, that's going to become so important, particularly for you as brokers and what relationship you have with your clients. So, quick look at the headlines. Again, this was up before Friday, so there's none of what's been going on over the past few days. But when in 2021, everything was Brexit, everything was COVID. In 2022, everything seems to be crisis. Fuel crisis, energy crisis, war, cost of living, the pound now tumbling. It doesn't paint a great picture, but are things as bad as the press make them out to be? Or is this, again, another case of social media, the press sensationalising things and actually making things seem a lot worse than they actually are? I don't have the answer. It's just something to think about. I won't go through the timeline in massive amounts of detail because I know Neil did that in his presentation, but obviously all these things have kind of contributed to the current economic situation that we are now facing. One thing that Neil didn't call out in his was just the Brexit changes at the beginning of the year, so everything to do with goods coming into the country, leaving the country, all the additional checks, that has added to the economic pressures. It's also worth saying at this point that where we are at the moment is a false economy. It isn't a true economy that we're in at the moment, because you can't be after you've gone through Brexit, after you've gone through COVID, after you're dealing with the war in Ukraine. It's not a true reflection of the kind of global situation. And actually, the theme from the presentation, you'll see that we need more time to really understand the full impact of all these things and to really understand what our economic outlook is going forward. So, inflation projections. Now, interestingly, since the mini-budget, I haven't actually seen a lot of press on inflation projections at the moment, which is interesting. So, don't know what the latest prediction we've got on here is August 2022, so I don't know whether they've now reforecast, but I haven't seen anything to say that it's changed yet. So if you look at these 2 graphs in detail, the first one closest to me is the inflation projection. The one on the other side is how much energy is contributing to inflation. And you can see the latest one, which is the top spike, August 2022, predicting inflation of 13%. 6% of that is energy. So energy is causing the big spikes in inflation at the moment, which I know that you are all aware of. But the predictions are still coming down. You know, everything is still pointing towards the goal of 2%. And it is generally felt that by 2024, we will see inflation return to normal 2% levels. Now, again, I don't know what the forecast looks like as a result of the past few days, but I would guess that it's still a very similar kind of spike and then coming back down. And I think that's the key takeaway from this slide as well. So yes, inflation is high. There are supply pressures. Energy is responsible for a massive part of the inflation. But once again, it is forecast to come down. And that's the bit that the press kind of don't report. They only seem to report the worst case scenario. And we don't even know that inflation will rise that high because there are many factors that we still need to consider. I don't know whether anybody's been reading over the last few days, but actually the price of oil has dropped. The price per barrel has dropped by about $15 because what's happened, countries have been stockpiling. So it's taken the pressure off a little bit. Obviously, the states are in a really strong position when it comes to energy because they can rely on their own resources. They're not so reliant on Russia, whereas UK, Europe are. But that pressure is already showing signs of starting to ease and prices have dropped. Cost of living, so obviously a really big topic at the moment, led by the pressures on inflation. And again, I'm not trying to take away from the fact that it is challenging out there and people will feel it. Not necessarily people in this room, but certainly people in the UK will feel the price of inflation. They will feel that. But again, what is not kind of discussed is all the support that has been given to people. You know, the press fail to mention the kind of general package. And I'm not understating, you know, how challenging it may be for some people. But again, it's not completely dire straits. So to give you an idea of what the support measures look like, we have had a national wage increase to £9.50, so that's about another £1,000 for workers each year. There's already been energy support, so £400 to all households, additional £650 to means-tested benefit households. Pensioners will get additional winter fuel payments on top of what they already get. State pension's going to be increased. Obviously, we've seen, as a result of Liz Truss's government, we've seen the energy price caps. We've seen further support measures given out to try and help energy bills. Interestingly, the cost of that bailout was £190 billion. The cost of the COVID bailout was about £400 billion. The cost of the tax cuts, assuming she doesn't reverse them, is about £80 billion. So there's quite a lot of debt that the country is in at the moment, and that has obviously caused the issues with the pound over the last couple of days. But again, and what's interesting here is that the UK's debt to GDP ratio is 100%. That sounds like a lot, but France is 115%. Italy is 150%. So again, it's about putting it into context, not trying to say that the world is great, everything is fine. Clearly it isn't. But I think what the press miss is the actual, is the context and the parity and making it a fair comparison between other countries, and that's the bit that they don't do. Job vacancies. So this is a positive slide. This is a genuinely positive slide. There are a record number of vacancies. Unemployment is still at an all-time low. Despite COVID, we've seen really strong bounce backs in the hospitality industry. The demand for construction workers and manufacturing workers is still really, really high, which is a really great position to be in, particularly when we're facing a cost of living crisis. The slight downside to that is that it pushes earnings up because there are so many vacancies, there are not enough people, allegedly, to fill those vacancies at the moment. So employers have to make their positions look more attractive, and one of the ways they do that is by increasing the amount they pay for those workers. Again, fantastic for people that are taking those new jobs, but what that means is that they have to recoup that cost somewhere. The way they do that is by increasing the price of their goods and services. So it adds to an already high inflation prediction. So good on the one hand, but doesn't necessarily help inflation in other areas. The housing market. So a really relevant topic of conversation for us in this industry. So as Neil mentioned, the house prices on average have grown 20% since before COVID. Obviously, last year we had the stamp duty holiday, which kind of skewed the figures. But even this year, the average rate of approvals or purchases per month or transactions or whatever is 105,000 a month. So that is pretty much the same as where we were pre-pandemic. So the housing market, once again, has shown resilience and has shown a strong recovery. Now, with the events of the last few days, they have predicted that the Bank of England base rate now will rise to as high as 6% towards the back end of next year. That is only a prediction, and it is only as a result of the activity of the past couple of days. We are expecting the Bank of England to rise by 0.75 in November. That generally seems to be accepted. And what that could potentially do is have a knock-on effect to house price growth, and we could potentially see a 10 to 15% drop in house prices next year. The reason for that is, as you know, it makes borrowing more expensive. In terms of housing affordability, and again, a really big topic at the moment, so you can see that people are borrowing more against their incomes. But I think it's really important to note at the minute that this is not credit crunch lending. This is not 89% self-cert mortgages. This is not 100% Northern Rock together mortgages. I think that's what they were called. This is a completely different situation to what we dealt with back in the credit crunch. And as I look around the room, I can see that there's lots of experienced people in this room, and they were around during the credit crunch of the last time. That's a polite way of saying you look old. Just joking. I was around then. But anybody who lived through the last credit crunch should understand that the situation that we're dealing with now is not that. The credit crunch was about funding, about how lenders lent money to people, how liquidity, capital adequacy. This is not that. Lenders stress test a lot better than they used to, a lot stronger. The income multiples are nothing like what they were back in 2008. You used to be able to get 6 times. I think 6.5 GMAC did at one point. Max you've been able to get here is 4.5. Now, the Bank of England have recently changed their affordability policy to allow people to borrow more money, which is a positive thing. Okay? It's not highlighting that people are going to need to borrow that. It's highlighting that their policy was based on a situation that happened 15 years ago, not where we are at the moment. So I think in general, the housing market, we need to see what's going to happen to the rates. Potentially, we're going to see a drop. But overall, the housing market has proved resilient through credit crunches, through Brexit, through all the other issues that we've had to deal with. And one of the reasons for that is a result of you guys and what you do for your customers. The other thing to mention is just on the fixed rates, on the mortgage rates at the moment, 80% of people are still on fixes. So they are not going to feel the impact of the base rate rises. I was talking to Sharon and Neil earlier. They fixed on 7 years, 5-year rates. They're laughing at the moment because they're not going to have any hikes in payments. And that will be the case for a lot of people. There will be customers that are coming to the end of their deal and will be worrying about the rates. And again, this is why you guys as brokers are so important, because it will be down to you guys to educate them, make them understand the situation in the market at the moment. Right, I'm going to flick around these slides a bit. Oh no, it's all right, it's been done already. So the big topic in the mortgage market at the minute, and as a result of everything that's happening in the economy, is swap rates. Swap rates are what are causing you all the headaches at the moment. Okay? This is why lenders are pulling rates left, right and centre. As a result of the mini budget on Friday, as a result of the pound tumbling on Monday, swap rates jumped by a crazy amount of money on Monday. And suddenly every single lender had products on the market that was not making them any money. Believe me when I tell you, as a lender, we do not want to pull products at the drop of a hat or give you hardly any notice. It does us absolutely no good from a relationship perspective. It does us no good from a service perspective, because what happens is we get spikes. We get a hell of a lot of business in a very short amount of time, and we can't service it. So I do not believe for 1 second that any lender in this room has pulled rates without, really considering the full impact of what they were doing. And it got to the point yesterday where we had to do it. We were losing money on those products. The good news is everybody will reprice and those products will be back on the market and things will calm down. But again, this is where the press doesn't help. It's in all the national newspapers that Halifax pulled their rates, that Virgin Money pulled their rates, they've stopped lending. Nobody has stopped lending. Okay? Everybody has still got products out there, just might be priced a little bit higher than they were 24 hours ago. The other thing with swaps at the moment, and this is where the non-bank lenders have to kind of consider where they are at the moment, because non-bank lenders use swaps as a way to get funding to then lend out. And they're the ones that are potentially going to fall under more pressure going forward as it becomes more expensive to borrow money. And the reason for that is because they use swaps in order to price and how much they buy the money in at. And because swaps are changing constantly, it makes it really, really difficult for funders to price that money. And as a result, you might potentially see some non-bank lenders exit the market. It's still kind of pressure for bank lenders because bank lenders still use this as a way to lend some of their money. So there is massive pressure on lenders at the moment in general to kind of get the money, lend it out, and also make a profit on it. But I do genuinely think that things will calm down in the next couple of weeks and we will just kind of take this as a blip. Because of the time, I'm just going to go on to the last subject, and it's the one I mentioned about at the beginning. With everything that's happening in the industry at the moment, there is a high chance that your clients will not know what's going on. There is a high chance that many of your clients weren't around in the credit crunch or didn't understand, didn't have a mortgage in the credit crunch that now do. They do not understand what base rate rises mean for them. They do not understand the impact that that's going to have on their mortgage payments. And they also have only got social media and the press. When the press report there's going to be an economic crash, the pound has tumbled. They don't report that the pound recovered, they just report the bad stuff. Your clients are seeing that. So now is the time for you guys to steady the ship, to keep calm and carry on, because if anything, the mortgage industry has proved resilient over the last 20 years. We've survived the credit crunch, we've survived Brexit, we've survived affordability changes, we've survived regulation, and we will survive this now. But it really does come down to you to help the clients navigate through it. Apologies, it's been a bit wishy-washy, lots of kind of new things to talk about. If you do have any questions, please come and see me in the break, but thank you very much for your time.